Welcome to another episode of the Capital Playbook. My name is Charles Williams, and I am the owner and managing member of Pioneer Realty Capital, and we are so excited to have you with us today. We are in San Diego at the MBA conference. That's the Mortgage Bankers Association conference. And this is a great opportunity for you to be a part of this because we're here talking to players in the financial markets here as it relates to commercial real estate. And today we have with us a special guest. His name is Mr. Michael Klein. Mr. Klein is with Freedom Financial. Michael, it's a pleasure to have you with us today.
Well, thank you, and thank you for having me. It's very exciting to be here.
Yeah. Well, I had a chance to meet Michael the first time. I think we were in Beverly Hills at a conference, and we've kept in touch over the years and always have been excited about their business model. And I think you're going to be very interested in hearing what he has to say about how his company and the products they have, financial products they have, bring value to folks who are investing in commercial real estate today. And so, but before we get into our conversation, as you know, there are a couple of housekeeping things that we always want to mention. One, show me that you like us. And you can do that by liking our podcast, supporting our podcast show by subscribing, and also click that little bell to remind you when our show is going to be aired. And if you are on Apple or Spotify, go and join and subscribe and be a part of this conversation. This playbook is very valuable because it teaches you how to win. So with that out of the way, and that being said, let's get into our discussion with Mr. Klein here. So Michael, tell me a little bit about yourself. How did you get into the commercial real estate business?
Well, it started coming out of college. I was an undergraduate finance major, and I wanted to get some excellent training, and I was very fortunate at the time to be able to join a bank in Los Angeles by the name of Union Bank. And while I was at Union Bank, I went through a couple 2.5-year training program and in credit and management, and spent the first couple years on the line in commercial real estate. In commercial lending. Mm-hmm. And but I always had an interest in real estate, and so I made it a point to ask my supervisor, if I do a really good job, would you recommend me to the real estate department? Mm-hmm. And so I worked hard, and I got that recommendation, mm-hmm. and I went to work in the real estate division back in 1987. So been at real estate finance for a bit of time. And that's taken me to a lot of different places. The first 15 years was in commercial banking. I went on and got an MBA and had an interest in entrepreneurial ventures. Mm-hmm. Left banking, did my first startup, ran that for 5 years, sold it, and then came back to California for some family matters, and came back into banking. And found that there was something missing. Something had changed over 20 years.
Oh, wow.
And so that's sort of how we got on this path of doing what we do today.
Okay, well, very great. So so you mentioned that you're involved in commercial lending and got into commercial real estate lending, and you identified that there was something missing in the industry. Right. What was that exactly?
Well, in the mid-1980s, a lot of bank executives made it a point to start saying that training was too expensive. And so bank by bank started to eliminate training programs. Now, what happens is if you're in a service business like banking, okay, it's all about the skill sets of your people.
Right.
And to the extent that you start eliminating training, you have to eliminate the ability for the untrained to make decisions, right? Because you don't want people who aren't trained making decisions,
right?
Which means that you have to start centralizing decision making. Okay, and so you go from a decentralized world of skilled people to a centralized world of very few skilled people with a lot of people that aren't as skilled. Okay, that means that your ability to get a premium for whatever service you're providing diminishes. Okay, and over the 35 years since that became a bit of became a mantra. Training's too expensive. What we've seen is that banks have resorted to calling what they do a product. Okay, and it's a very narrowly defined product, to use their terminology, that customers almost have to modify their lives to fit.
So, Michael, that's very interesting that banks would stop doing training, and now they're starting to see this as a product. You're mentioning that when you no longer have that skill pool of individuals, and that decision making becomes centralized as opposed to decentralized,
right?
It affects the value as a banker that you can now add to your clients.
Right.
Now, you guys saw an opportunity to come in and fix that, right?
Right. So I, as I mentioned, I came back into banking in the early 2000s after having been gone for approximately 5 years.
Right.
And I came to the conclusion that because I was now at a regional bank, I had been at a money center bank, and it was an amalgamation of a lot of different banks, and there was no culture left, and there was no credit culture, and so people were talking past each other, and I didn't think that was unique to that bank, but I wasn't convinced, and so I eventually found another job at another bank, and guess what? Same problem, right? And so what I came to the conclusion in around 2005 that there needed to be a private entity that could do construction lending on a customized basis. Okay, and so I started talking to people I knew, primarily family offices, to try to fund it, because it's capital intensive. You need a lot of money to do this, and in 2005, 6, 7, you could get money if you were breathing. Right? And everybody should be reasonably familiar with the meltdown that we had because money was so available,
right?
And so we didn't fund it. But going into 2008, things were tightening up, and so I convinced a gentleman I knew who was a high net worth individual that it was time, and so we launched in the summer of 2008 with our first meeting to raise money a week after Lehman Brothers went bankrupt. Okay, and it's interesting
timing.
Well, it is interesting timing, but there's tons of entrepreneurs that have ended up building great businesses when rising from the ashes.
Absolutely.
Right? And so we raised a few bucks. We raised like $14 million, and in that initial meeting, and we opened our doors in January 1, 2009, and there was no capital, but we had some, right, and so we started trying to find users of that capital, and it took 9 months, and we found one, and it was a great deal. It was a fabulous deal. It was a building that was half built. The borrower had been talking to his relationship bank of 20-something years, for 9 months to get a construction loan so he could finish a building that was pre-leased to the county of San Bernardino.
Wow.
Okay, which is a double. It's a double A. It's a double A or double A plus credit. Right. Okay. I mean, so what we were able to do is give him the other half of the money that he needed to finish that building for that obligation, and that got us started. And then we kept finding deals like that, and so here I am 12 years later, second company, and we've done about $1.6 billion in loans.
Wow. So Freedom Capital, Freedom Financial,
Right.
is the company you're with now. And you got started in what year?
We started this company in 2016.
Okay, so in 2016, you guys have raised money. Now you're out lending that money out to a specific client. What is that client profile that you guys look for?
Yeah, so we're very focused on winning relationships with bankable clients.
Okay.
So today, our book of business, our client base, are seasoned, experienced real estate investors and real estate developers. We're not the right source of capital for the person who's doing their first or second deal.
Right.
That's a choice that we've made. But all of the people that we do business with at some point did their first or second deal, right? And there's some lessons that we can talk about, throughout the program about what they've learned and what we've learned.
Right.
But our client comes to us because they've found that that they can count on us as a reliable source of capital to facilitate the capital needs that they have to complete projects. And everything that they're doing tends to be a relatively quick turn, 12 to 18 months. There's a big value added component. So they're usually either building ground up, something new. So they get somebody that wants a new building and they're build it for them, or it's a new apartment building, or they're fixing something that is already existing but not doing as well. So it could be an apartment building that's been undermanaged for many years, or it could be we just closed on a deal just yesterday. It's in North Phoenix. It was an existing restaurant building, empty. Our client went in and bought it, but is a professional that really knows not only Phoenix, but knows most of the tenants or many of the tenants in the market. Found the tenant, it's a terrific operator, and then came to us and said, can you help us with the money that we need to finish this out? And we said, of course we can, because the economics of the deal were very favorable. They had a well thought out business plan that made making a loan much easier.
So now, one of the things that you mentioned was that you are targeting bankable clients.
Right.
But the obvious question would be, if the client is bankable, why are they choosing a non-bank route through you?
Right. So that's a great question, right? And it's the hardest part of our first sale. Okay. Why? So if you're perfectly happy driving a basic car, okay, and you can pick any basic car you want, whether it's a Chevy or a Toyota or whatever.
Right.
Okay. They're fabulous today.
Right.
And they get you from point A to point B and get good gas mileage, and they all have air conditioning, and they all have a decent stereo, and they're fine.
Right.
Yet on the highways, you do see people driving S-Class Mercedes and 7 Series BMWs, right? And
I'm a fan of Porsche myself. But
well, I am too.
Right.
But the point is
right.
that whether I am lucky enough to own a Porsche,
right.
If I'm in my Porsche and there's traffic,
right.
I'm stuck in the same traffic as the guy next to me in Toyota, right?
Right.
Okay. And he paid a lot less.
Right.
Okay. But I really like my Porsche.
Right.
Okay. And you really like them too, right? And most people really, really like when they get to sit in an S-Class Mercedes, they just go, wow, this is really something. Our clients are bankable. They drive S-Class Mercedes. So they already understand the concept. Okay, if I buy a premium product and get a premium experience, okay, then it's worth it to me. Okay, now if I buy a premium product and don't get a premium experience, then it's bad value, right? But so what we try to do is create a premium experience. Because we charge a premium price for our money, we're private. We're not subsidized by the federal government through FDIC insurance. We don't lever at 11 to 1, which banks do.
Right.
We lever at 0 to 1. So we are using our equity capital that our investors have entrusted us with to make these investments, by the nature of just how we're organized, we're going to be more expensive.
Right.
And so a borrower needs to be confident that they're going to get something special for that. And what they get is to deal with, in our case, principals that have decision-making authority, have the experience to make those decisions rapidly and rationally. Okay. Yeah, so many private lenders will talk about speed to close. Okay, and that's great. If you're getting a fully funded loan that is a couple $1,000,000 or a couple $100,000, it doesn't really matter. What matters is it's fully funded. So on day one, you sign a note, say for $200,000, and that all that $200,000 comes to you. Well, you don't really care how good that lender is after that. You've got the money. They don't.
Right.
It's their problem now.
Right.
But we do a lot of value add, right? I said everything that we're doing, there's a value add component. Well, in value add type lending, there's future draws.
Right.
There's always next month. Okay. And that's where we really earn our stripes. We can close deals quickly, 2 weeks, 3 weeks. That's quick. Okay. We can understand complex deals. That's good, right? We don't automatically say no because a transaction happens to be structured as a ground lease. Okay, that's an instantaneous no at many banks, right?
Not because they're bad deals.
Because they don't understand them. Right. They don't want to go through the effort to actually just read a lease. Right. So good. I'm happy that they won't, because that gives us the opportunity to read the lease and get the deal, right? But it's that service after close that really, that's what differentiates the premium experience. Right. So again, you buy a premium car, right? And you take it in for service. Well, you don't get a dirty car back. Right. You get a clean car back. Right. And not just cleaned, but really nicely cleaned. Right. It's not like it's just run through a tunnel wash. It's nice, and everything about it, right? You're treated with a certain level that's just above and beyond. But that's your expectation. Absolutely. And it should be, because you've just spent a lot of money on a piece of transportation. Well, you're spending a fair amount of money with us as a private lender, but in exchange, when you're 3 months into a project and you've got an overrun in electrical, but you've got some savings in plumbing, you can call up my partner, Minda, key word, okay? She's a part owner in the company, okay, and super experienced, been doing this as long as I have, and she looks much younger, okay? And call her, and she understands exactly what you're asking for immediately. And if it makes sense and we're not adding to the risk of the deal, we'll just move the money from one to the other and it's done. Right. At a bank, we were talking about that centralization that comes from not having trained people. Right. That could be a 3 or 4 week conversation. Right. And they're trained to stick to the letter of the law and not the spirit of the law. And that yeah, it's I'm not even sure it's that. I don't know that within their authority chain they just can't do it. They can't do it. Yeah. I mean I'll tell you, I was a 20-year banker when I came back. When I was back into banking, and I had in a previous life worked at a money center bank. It was called Chase, fairly big bank. Fairly big, and I was writing the report cards for Chase business unit heads and delivering those reports to the audit committee of the board of directors. So I knew a little bit about credit. Okay, I came back into banking because they didn't trust anybody. Nobody had authority. I couldn't even approve a $5 overdraft. Wow. Okay, that's common in the bank world today. It's not universal, but it's common. Right. Okay. Yeah, and we've had episodes where we talk about the fact that banks are different, and you really need to understand your bank, and even the importance of interviewing your bank, especially if you are in the business of using the bank as a service provider to you. Right. Now, there's one important point that you and I discussed. In fact, you mentioned it earlier, and I really want to highlight how important this is. The one phrase you used about your service is that
you add value by being a reliable source of capital.
Right.
And now talk about that in the context of COVID.
Sure. Back in March, we had this new experiment called 2 weeks to stop the spread.
Right.
Yeah.
Did that work, by the way?
Well, it's only been 23 months, so yeah. So all of a sudden we entered into this new world order, right? Which was we were going to shut down commerce,
right?
And then we were going to start defining who had a valuable job and who didn't, right? And within the markets, all capital markets, people woke up and said, wait a minute, what's going on, right? And quite frankly, no one knew, right? Because we're in uncharted territory, never been done before. And capital sources started to panic.
Right.
There was a distinct sound of panic that ran through everywhere, and every one of us had some level of disruption.
Right.
Okay. We choose not to leverage our book. Okay. So we don't have reliance on banks to make our next loan. Okay. In full disclosure, we have what's known as a subscription line. Mm-hmm. And that subscription line allows us to make a loan in advance of taking down commitments that we already have. So it's a huge convenience. And in fairness to our bank, they didn't flinch. Mm-hmm. Also, in fairness to our bank, if we were fully drawn on the line, it would only be approximately 13% of our total balance sheet. So it's very, very low risk to them. But those people that had lines where they were leveraging at 65 to 75 or 80%, those lines got frozen. They stopped funding. We didn't. Right. We closed new construction loans in April of 2020, while very few others did. So we continued funding all of our construction draws when others stopped.
Right.
And that was about a 4-month interruption on average. Some companies were out for 2 months, some were out for 5, but I would say it was about 4 months.
Yeah. If you're a developer,
or borrower, you've got payrolls. You've got you have contractors, and they have payrolls.
Right.
And so we didn't suffer that because of the way that we choose to run our business. And so we say we're a reliable source of capital because we have been. Right. And we haven't missed a beat in the 12 years I've been doing this, and we hope not to ever in the future because we structure to be safe.
Okay, well, perfect. Well, real quick, tell me about your basic lending program. So what type of leverage do you like? What type of assets do you like?
Sure.
What range do your rates fall in? If someone was looking to do business with you and you were to define the right customer for you, now what we already talked about, it can't be their first or second deal.
Right.
But there are certain things that you're going to like about a client, but they're the product that you sell in terms of your loan product that you're proposing to them. So tell us a little bit about that.
Yeah. So we're going to structure our deal to match their deal. Okay.
So as opposed to like a bank where you have to fit that deal into the bank's credit box.
Right.
You're fitting your credit box around their deal if it's the right client.
If it's the right client, well, I'm going to back up a little. So we underwrite every deal the same way every time, each time, all the time.
Okay.
Okay. And that way is that we look at the people involved. That's that bankable profile, right? People that have the capability and capacity to carry out the business plan that they're proposing. Okay. Credit. Have they done what they say they're going to do on a consistent basis? And if they've had a hiccup, do they come clean? Yeah. Do they come clean with us?
And that's so important because so many people. I just had a deal this week where we actually had funded the deal.
Oh.
And then we're in the process of funding another part of the deal.
Yeah.
Found out the guy's been in indictment by the federal government.
Yeah, that's kind of a material thing.
Yeah.
Yeah. Yeah.
So,
We always tell people we're going to do full background checks.
Right.
And so if you've got something in your background, tell us now.
yeah.
Okay. And if we can work with it, great. If we can't, we can't. But we're going to let you know really quickly. But don't make us go and spend your money, by the way, because they pay for it.
Right.
For
all the due diligence fee, in case you don't know.
And we're going to spend $1,200 or so on a big background check, and we're going to find out if you've been indicted. We're going to find out if you've been through bankruptcy. We're going to find those things out. So don't surprise us, right? So people, credit.
Right.
Okay. Then the real estate piece. The real estate piece is, does that business plan make sense for whatever the real estate is in whatever market it exists, right? The fourth piece is, can we structure a loan for that business plan, right? Can we make the purpose of the loan match that? If we can, great. If we can't, we don't, okay? And by that, so if somebody has a 10-year business plan, we're not the right guys.
Right.
We're a 12 to 18 month sort of term, right? So if you can go in and you can fix something in 12 maybe 24 months, on the outside, then we can try to structure for that, okay? And then we make sure that we've got a plan A way to get repaid and a plan B way to get repaid without suing anybody.
Right.
Okay? If we can get through those 6 steps, we're going to get a deal done. All right? So let's go to the piece about our so-called loan product, if you will, which is really the fourth one, right? Can we structure a loan to meet the needs of the business plan?
Right.
Okay. Well, depending upon the profitability of the plan, we will we'll lend up to 95% of the total capital required. Yeah, 95, right?
That's pretty good.
Big number.
That reduces. So it's funny because you started earlier by talking about your cost of capital was more expensive than other banks.
Right.
Technically, that is not true.
Well, it depends, right?
Because of the fact your total cost of capital, because of if you're levering up, the total cost of capital is much lower.
It can be, yes, right. Because I had this guy that was in the Central Valley, California, farmer and a real estate guy, and I love farmers. Salt of the earth, and tell it the way it is, right? There's no sugarcoating it. And he was telling me about when he did his first apartment deal. It was like a 30-unit apartment, and he had to go out and raise equity capital. And he said, my daddy said to me, he said, son, you're paying 50% on that money.
Right.
And he said, no, I'm not. He said, are you giving half of your deal away? He said, that's 50%.
Right.
And so equity capital is expensive.
Right.
If we can structure a deal that makes it so that you can use senior debt to eliminate having to have partners, you get to keep the whole deal.
Yeah.
Okay. And so we'll go to 95 on it. I mean, it's, not every deal. There's
product,
a lot of
right customer,
right customer, right project, right profitability.
Right.
Okay. And it's got to have a high enough profit margin to support that.
Right.
So on a loan to cost basis, maybe 95, loan to value, maybe 80. The bulk of what we do is probably 75 or 80% loan to cost and 65-ish% loan to value.
And what's your maximum lending?
We're doing we're making loans as low as about $2 million. Okay. Although we'll go below that if there's some volume associated with it, and then on the high side is around 15 million. We've done a few bigger, but that's not the norm. And then price point, because everybody's, how much is your money, and so the lowest rate that we have in our portfolio today is 5.99.
Oh, wow.
The highest price money that we have in our portfolio today is about 9.99. 9.99, 95%
highly levered, right?
Yeah, 95% of cost financing on a construction project,
right?
That isn't proven yet,
right?
5.99. There's a tenant in place. It's cash flowing, and there's really not much left to do.
Right.
And then usually we're 2 or 3 points on the front end. We don't charge for appraisals. With rare exception, we always do our own in-house. And then loan docs will tend to be in the $6,000 or $7,000 range, depending upon the complexity, and that's it.
Right.
That's what the costs are. That compares to banks, right? Oftentimes people will go, well, I could go to a bank. Yeah, you're going to pay less than a fee,
right?
Half a point usually, 4 maybe 5% interest. You're going to buy an appraisal. That's going to take 2 months. You're going to have to get their environmental. Oftentimes we'll accept, third party, as long as it's a real third party report, we're going to accept it.
And you can lever up.
And we can lever up, right? Yeah. And that makes a big difference.
That is a huge difference on the cost of capital.
Yeah.
So as we wrap up, before we conclude, based on your experience in working with borrowers who are getting into commercial real estate, what recommendation would you make to them as they evaluate their capital source? What are the 2 or 3 key things they should be taking a look at?
Yeah, great question. Okay, so I think there's 2 big areas, and I'm going to address this one, and then I've got one I want to add to that.
Okay.
When you're borrowing from somebody and you're counting on them for the future fundings for your project to be successful, you're taking what's known as counterparty risk. Okay, most people don't think about that.
Right.
Okay. You want to ask that bank for references, or private lender,
right,
for references.
Right.
Who do you know that I know?
Right.
It's a great question. Who do you know that I know? Right. And then talk to those people. Have they been a reliable source of capital?
Right.
Okay. When you had a change order, how long did it take?
Right.
Okay. You want to know that. You want to understand how they're leveraged, how they're capitalized, because you're counting on them.
Right.
If they stop funding and you're midstream, you've signed contracts to fund.
Right.
Okay, you're on the hook. So that's really important.
And most people don't bother interviewing their capital source. It's something we always talk about on the show. If you're relying on them, that counterparty risk, you want to know what their risk exposure is, and we talked a little bit about that.
Right.
And so if you're getting into this business, that is a piece of key advice.
Yeah.
Go ahead.
Yeah, and the other piece is, especially for new people. Okay. Nobody's become wealthy losing money.
Right.
Okay. So rule number 1, don't lose money. Okay. Rule number 2, don't lose money.
Right.
Okay. And rule number 3, don't lose money.
Right.
So how do you do that? Right. Because you can't make money if you don't take risk.
Right.
Right. And by definition, risk, most people just look at risk as downside, right? But risk is upside. You can't have upside without downside.
Right.
Okay. So risk by definition in statistics, right, is variation around the mean. Okay. Mean means that you've made nothing.
Right.
Right. That's a 0. Right. And so how do you make it so that you're advantaged to the upside and disadvantaged to the downside? Right. How do you mitigate downside? Well, plan A and plan B. Okay, and I talked about that in the 6 steps of underwriting any deal.
Right.
And so if you are looking at a deal and you can't figure out 2 ways to make it so that you don't lose money,
right,
go to the next deal.
Right.
Okay, there will be another deal tomorrow.
Right.
Okay, I had a client years and years and years ago have a little poster, a little post-it on his computer screen that he had a number of them, but this one stuck with me, and it was, the next deal of the century is just 2 weeks away. Right. So there will be another deal. Don't force yourself to do something if you can't figure out a couple ways to not lose money. Right. Because your plan A always works.
Right.
Right. Pro formas are wonderful.
Right.
Because they always look great.
Never seen a bad one.
Right. Exactly. You know. But the key is to have somebody that you trust
Right.
say, well, go through it and say, well, what if this happens?
Right.
And if you can't come up with good answers, go to the next deal.
Right. Good deal. Well, I tell you what, you have been a phenomenal guest.
Well, thank you.
And we are so happy to have you, your years of wisdom in this industry, the value you add just to us and the folks that our viewers on this show. I guarantee you they're going to probably be calling you and getting some more of that wisdom.
Great. Thank you.
Yes.
Thank you for having me. I really appreciate it.
Well, thank you for being on our show. Would love to have you back. We'll probably see you at another event. Of course, if you're in Dallas, stop by, be part of the conversation again.
Okay.
But again, thank you so much for being a part of our show.
Thank you.
Mr. Michael Klein, Freedom Financial. His information is on the screen if you want to reach out to him. He has a book. Tell us about your book real quick.
Thank you. It's How to Make Sensible Investments in a Senseless Economy. And it's on Amazon. Just look it up under Michael Klein. My partner and co-writer was Stanley Kafka, and you can find it there. So,
yeah.
And it talks about the 6 steps, and it's a really fast read. It's easy, and but it's practical, and it has helped a few folks not lose money.
There you go. So we'll have a link to that book on the podcast when you view this podcast. And Michael, again, thank you so much for being on our show, and thank you for being a part of the conversation. Thank you for tuning in to the Capital Playbook, a place where we teach people how to win by following these plays and getting involved in commercial real estate and keeping your money. And as you said, you never make money by losing money. So thank you again for being a part of our show.